Hello everyone, today we're going to analyze the stock chart of Tesla. Not so long ago, we did a review of this company and concluded that despite rather average economic indicators, the ambitions of this stock are like those of a superstar. It's clearly overvalued. But in that review, I said there were no clear reasons to open a short position because the basic conditions weren't met. As of today, these conditions have formed, at least the very basic ones, and I'll show you that now. So it's possible to start thinking about shorting. Let's look at the chart. We're looking at monthly candles. Notice that the November candle is currently trading, maybe it's not very clear, I'll zoom in, but it's definitely trading below October's open. In other words, we're seeing a bearish engulfing pattern. But this fact alone isn't enough, because there's still quite a lot of time left until the end of November, more than 2 weeks, which means it's too early to draw conclusions. Besides, we haven't seen a new all-time high, and that could indicate that the upward movement might still continue. If this decline had happened after setting a new all-time high, it would have been much stronger. Now let's remove my only line from this chart and highlight the following. Let's do this in yellow and bold. Here we had an all-time high. Notice where the RSI was. And here, let me mark it with a line. We had a lower value at the time of the new all-time high. The RSI was clearly lower. And here we also had an all-time high back in January 2021 and the RSI was also lower. And here, right around here, a similar situation. Yes, considering that the RSI dropped into the 50 zone, we can't really consider this peak and this one as a full-fledged divergence. But it's an indirect indication that this wave of growth with these highs is running out of steam. And as we approach the current all-time high, the RSI is clearly falling short of the previous one. But all these are just considerations that do not allow us or give us the right to open a short position. Let's switch to the weekly time frame. Yes, the only thing we need to identify in case of a decline is where we might end up. Still, if this decline does happen, it is very likely to reach the $403 level. This is the first basic level. The second basic level is not based on the red candles. They don't suit us. We take it from the green candle, which is $371. If we pass these two levels, then the next level is likely this reversal point. It has been traded quite well. This is the $297 level. This is just a reference point from the perspective of the monthly time frame. And note that the 50-month moving average is also pointing roughly to this area. And what else I would like to point out is that this 50-month moving average is green. We have already broken through it many times and even approached the 100-month moving average. This means that at some point the price may come into this zone around $176 to $180, which is the area of the 100-month moving average. Now let's remove everything for the sake of clarity in our experiment. Well, it's not really an experiment, it's an analysis, but just so nothing gets in the way. And let's look at the weekly candles. What do we see here? Here we see a fully formed divergence. It's very small, but it's there. Take note, here the highs are rising, but here the RSI highs are falling. What does this mean? It means that right here, in this spot, there is a clear divergence. Let's remove the circle and pay attention to another very important and significant thing. Last week engulfed the previous week of growth, which, by the way, although it didn't set a new all-time high, did provide the highest historical weekly close, and that's a very significant signal. Notice that the previous week's low hasn't been broken yet, but I'll show you now. This might take some time, that this low is very likely to be broken. This would mean, give or take, a move of about $20 down. And this could be just the beginning. Notice that every bearish engulfing pattern has ultimately been followed by further movement. Well, right here in this very spot, look, right here, this is almost a very rare exception. Yes, we did engulf this growth candle with the second consecutive red week, but there was no follow-through at all. But I'm afraid we're going to see that happen right now, and it will likely be below $413, which is an important level to watch. Now let's keep watching. Here's the base of the candle, which is the part at the bottom. Let me highlight it in yellow or maybe even blue so it stands out. $397. Notice, we engulfed it over 1, 2, 3, 4 weeks of decline. Then there was a rebound and the drop went significantly lower. The points where the engulfing happened of this green candle, let's keep looking, searching for points where we had an engulfing. Well, here we didn't have a full engulfing because first of all, we opened with a gap with a green candle and the red candles didn't engulf the green one, so we won't consider this case. Here there was an engulfing, yes, on the first candle and we immediately went down. Here there was an engulfing too, yes, we went down, but not right away. There was a rebound first. Almost back to the start of the drop, to the red candle on September 18th, 2023, but then we went down significantly. Here, as soon as the engulfing happened, the movement immediately continued sharply downward. Let's take a look here. The engulfing happened on this red candle right here. The first two candles did not engulf the green one. Yes, the downward movement wasn't extremely large, but the low of the previous week, the one that engulfed this green candle, was still broken. And then, after a correction, we went even lower. Let's take a look right here. Here is a clear engulfing with a gap down. Then there was quite a significant rebound, but the downward movement continued. Look here, a huge green candle. It was engulfed at this point. What happens next? The following week, the price went significantly lower. These are the weekly closing points. Let's see how much that was. The week closed at this level, and the low was 20% below the weekly close. And even here, where there was a candle of indecision, because its body was about the same size as its upper and lower wicks, in the end, from the closing point after the engulfing on this red candle, we got a 20% move down. Here we engulfed the green candle, and from the closing point where the engulfing happened, we went down by 21%, and you could go on like this endlessly. It's a very strong signal. Look here, here's an engulfing. I'm not cherry-picking specific moments, down 15%. I'm just looking at situations where this happens. Here, where did the engulfing occur? I'll zoom in on all of this for you, so it's honest, clear, and easy to see. Here the engulfing happens over 1, 2, 3, 4 weeks of decline, after which we see a further move down, well, until the first correction, that's 12%. Overall, the drop was 19%. The most basic things are very simple, but they're also very effective. I'm deleting all the markings completely. Let's see what else we have on the chart with weekly candles without focusing solely on the engulfing pattern. I told you that in addition to the engulfing, we also have a divergence. This only strengthens the signal. And we have a target level. These are the 50-week, 100-week, 200-week, and even the 300-week moving averages. Because, notice, we've broken through the 200-week average multiple times. So if the price consolidates below the 50-week average, moves towards it, and stays below, then with high probability we'll see a continuation down here to the 300-week average. That's the blue line. $236. That's a drop, well, maybe not by half, but probably around 70%. Well, actually not 70, I mean about 40%. Let's probably just look at it physically and estimate, well, here it's 45%, but in dynamics, this blue line is moving up, so it'll be about 40%. Twice would be 100%, 80% of twice is, well, it turns out that about twice is 50%, 70 divided by 2 is 35, so basically I estimated it at 35%, but called it 40%. Alright? I think you've figured out how I think. We need to mark some important levels. Which important level? First of all, this level right here. This is both support and a magnet level. Due to the previous absorption, we need to update this minimum of $413. So that's the minimum target. What's the second important level? The second important level is right here. It's the lowest close during the period, which for some time kept us from falling further. That's $394. And right here we also have an unfilled gap. But all of these are intermediate levels. The nearest important, truly significant level is this one. That's $349, or basically $350. If we assume that the decline will continue from roughly the current levels right now, then that's a drop of the same 20% that we've seen historically during bearish engulfing patterns. The picture is quite clear. But in any case, if you open a short position, you must set a stop loss. Let's assess the size of that stop loss. You should place your stop just above the high of this red candle, the one that created the engulfing pattern. And the size of that stop is 7.6%. In fact, this gives a risk to reward ratio of 3 to 1. That's classic, and these are the minimum conditions, which in this case are just barely met. But I expect the movement to go lower. That's my expectation. As we discussed before, we looked at why this might happen in the previous review. Today we won't be looking at fundamental data. We'll only be focusing on technical analysis. Daily candles. What do we see on the daily candles? We have a very significant consolidation zone. Take note. This zone is very likely a distribution zone, and why is that? Because we have a divergence and an engulfing pattern on the weekly candles, meaning the higher time frame clearly points to a downward priority. So this is most likely not large investors buying up shares, but rather them selling off. Now we need to determine where this sell-off could lead on the daily candles. First of all, here's the lowest close. Let's adjust it now. That's $379. And the second level we had was 350. And here it's 362. So this is our target zone. I'll wrap up the review here. I don't want to speculate too much or drag this out. So our target zone is in this area. And with that, we'll end the video. However, I don't rule out that the movement could develop much further down, all the way to an RSI value of 30, where the downward move might stop, or it might continue. Subscribe to the channel if you find these reviews high quality and useful for you. And leave comments about which instruments you would like to see covered in future reviews. Goodbye.